Guys, all right, let's move lastly into our weekly segment we do on Wednesdays that we call Jedi Options. And Coach Tyler is definitely with the Force, I believe. He has it streaming through his veins. And he goes through some concept in the options market, whether it's a strategy, a couple of different companies, different ways to play it, or like today, a teaching concept where he's going to highlight something to teach people about options trading. And today, Tyler, we're going to be focusing on the market maker move. And when we're in earnings season, this is a very helpful tool for any trader, whether you trade options or not, by the way, to understand and assess potential volatility around earnings gapping and whatnot. Show us what you got here on MMM moves and explain this to the audience if you can.
Yes, as if you've noticed, I pulled out a Word document here. So you know it's going to get good. Going to take some notes. Don't usually take notes, but I got the go-ahead. I got the go-ahead from the Justice Brothers. They said, hey, you can teach your concept. So let's dig in here. When it comes to set the stage, you have direction. You can say, hey, is this stock going to go up? Is this stock going to go down? Right? So which way is the question, right? And then the other piece of analyzing asset prices has to do with magnitude, which the two questions here are how far, right? How far, and maybe even speed, right? How fast. And when you talk about directional trading, it's all about delta in the options markets, the Greek that we use. Is it going to go up? Is it going to go down? That's what stock traders are obsessed about, right? Every day, up or down, up or down, up or down, very binary. That's the game you're playing. When it comes to volatility, it broadens your horizons. It gives you other things to consider and play with. That's the context. That's the world that we're in with today's discussion. Magnitude, speed, how far, how fast. Those are volatility questions, right? Those are volatility questions. Volatility is all about the magnitude of the move. Which direction doesn't matter. Which direction doesn't matter. It's more so just how far and how fast can be part of that. So when you think about the market in general and specifically with an earnings announcement, there are volatility expectations. Okay, volatility expectations. It's not just completely random. It's not like we don't know anything about what's going to happen with an earnings announcement. The unknown really is the direction, right? The direction of the gap. Will Apple go up or down after the earnings announcement? Will Microsoft go up or down after the earnings announcement? That's a coin flip, 50-50. You really have no edge if you're betting on direction going into earnings, which is why, in the case of NEO, like, look, you don't want to play that game. You can play any game you want. There's a million games you can play on Wall Street. Do you really want to play the game of guessing if the stock's going to go up or down on earnings? Why? There's no edge, okay? We don't know. What we do know and what we can start to make some educated decisions around is how much a stock's going to move. So there is a known, which is what's priced in from a volatility perspective. So it's incomplete to say, hey, everybody thinks that Apple's going to go up or down tomorrow on earnings. Yeah, no crap. Of course it's going to go up or down on earnings. That's not interesting. What's more interesting, though, is like how much does the market anticipate Apple's going to move? Okay, this how much question. We know this. We know this by looking at what's known as the market maker move. So the market maker move is what the stock market through options trading is baking into the cake. Okay, it essentially tells you, and it's very accurate when you look at it over long periods of time. It's pretty consistent. And if it's inaccurate, there's nothing more accurate than this. Okay, it is the collective wisdom of Wall Street. It's not just me. It's not Tim. Anybody who's placing money on the line is impacting this market maker move. So it's pretty accurate. And so essentially, the MMM or market maker move tells you again what is expected. So if you go to your trade tab, we have Amazon earnings coming up imminent. We have Facebook earnings. So let me take a look at Facebook. Okay. So you go to the trade tab and toss, you go to Facebook right here in yellow, plus minus $15.96. Let's just round it to 16 bucks. Okay, plus or minus 16 bucks. So what does that mean? Well, we know Facebook, they're telling us right here, it's got earnings after market on 7/28. That's today. This reports after the bell. Is Facebook going to go up? Is Facebook going to go down? I don't know. 50-50. We'll see. Okay. So I don't want to buy Facebook guessing it's going to go up. I don't want to short it guessing it's going to go down. There's no edge there. But we don't have to say, hey, maybe it's going to go up $100. Maybe it's going to go down $100. No, it's not. You're not completely in the dark for how much it could move. The market is telling you, based on what everybody is betting, based on the money that's on the line, 16 bucks is what's baked in. So market maker move for Facebook is $16, and it says plus minus. Why does it say plus minus? Because we don't know if it's going to go up or down. Okay, it could go up 16, could go down 16. That's what we call the expected move. You'll see that term a lot, the expected move. Okay, now you can put some probabilities around that. So you could say, well, like 100% chance it's going to go up or down 16 bucks. What's the likelihood it's going to do that? Are we confident enough to say it's 100%? No. The way it works is that $16 for the market maker move is one standard deviation. In fancy terms, you say it's 1 sigma. Okay. And when you go and learn statistics and you learn about a data set and getting the average and the range of outcomes, what 1 sigma represents is 68.2% of all outcomes, which loosely like 2/3. Okay, 2/3. So what they're saying is that Facebook has a 68.2% chance of gapping up or down $16 or less. It can be within the range too. So that's what the most likely scenario is for Facebook, to be up or down 16 bucks or less, somewhere in that range. That's the most likely range, most likely meaning 68.2%. So if this is accurate, then over the next million times that Facebook reports earnings, 68.2% of the time, it should move less than 16 bucks. And so you could draw a range around this. You could say it's at 37, 33, I can't count, $377.55 plus 16 bucks. So 393.55. That'd be kind of the upper edge of the expected move. And then you could subtract 377.55 minus the 16 bucks. So you're like 361. That's the lower end of the range. Okay, that is the range that Facebook is expected to trade in essentially tomorrow, right? It's got earnings tonight. And so tomorrow it should gap and the price should land somewhere in this $16 range based off what the options are pricing in. So to our earlier point on Apple moves 1%. Is that a big deal? Not if it was priced in. For Facebook, if Facebook goes up $8 tomorrow, is that a big deal? No, it was baked in. If it goes down $8, is that a big deal? No, it was baked in. What would be interesting is if it moves more than $16, right? So say Facebook goes up to $400. Well, now I'm interested. Now it's interesting because it was more than was likely, right? Doesn't mean it's impossible. In fact, if you take the inverse of this, $16 1 standard deviation, 68% of the time. The inverse of that says Facebook has a 31.8% chance of gapping more than $16. So if it gaps more than 16 bucks, it doesn't mean the market maker move was wrong. It's just the 1/3 of the time it moves more than expected. Okay. Okay. That's your math lesson. That's how the statistics work out. Now, the next piece, which I could talk about for 3 hours, is what do you do with that information? So piece one is, what is the information? What does it mean? Now, forevermore, you can, anytime you want, come in, and usually it's displayed here just before the earnings announcement. This will show up, okay? Oftentimes after the earnings, it goes away. You say, well, how do I know what the expected move is? Just look down to the right. Okay, you can see plus or minus 17 bucks, plus or minus 21 bucks. These are the expected moves with each earnings or with each expiration. Okay, so even if the MMM isn't up here, you can still get the read on the right. Okay, but the point is you're not flying blind into Facebook earnings. You can know what the market's pricing in, and then if you want to trade, you can then make a more informed, educated decision. Okay, so I could say, hey, what do I think? Do I think Facebook's going to move 16 bucks? Do I think it's going to move more than that? You can start to build volatility trades around that, depending on what your opinion is, right? Don't know if we're going to do that today, but that's the first part of what is the market maker move.